Neil Kashkari said it, right? It's an open question, kind of how far the Fed can really go. What do you think? How much further do you think rates can actually go?
I would say in a base case scenario, you're looking at a range of between 5 to 5.5, where the Fed will actually maybe take a pause sometime in the next couple of quarters. So from the standpoint of obviously the markets rallying and pricing in a pivot or a Fed, in fact, cutting rates at some point late next year, I think it's premature. It's trying to undo what the Fed is trying to do, which is tighten the financial conditions to some extent and bring inflation under control. So I think we still have some room to go before the Fed pauses.
So Neeraj, what do you do then now when, to your point, the Fed says, we think rates will peak at XXX, but that could change, and we're this deep into the tightening cycle. I mean, how do you formulate an investment strategy around something that perhaps they don't even know where they're going to go?
So first of all, it's very important to listen to the Fed. And I think they have been very clear in terms of the communication with regards to their policy objective of getting inflation back under control. So from an investment strategy perspective, I would say, first of all, overall, you still want to be cautious. You still want to be short on the duration side, and you still want to be closer to home in terms of risk. So from a part of the market that you still can actually build certainly some carry with is you go up the quality curve, you go up the capital stack, and you stay closer to home in terms of duration. So with the short duration investment grade credit, you can start building some carry. And as the rates wall starts to come down, you can go then at that point out on the duration curve and down the credit curve. But it feels a little early to actually take that call right now.
I have to ask about just the dollar then. Do we have to, is that kind of one of the still key factors in whether we see that risk rally sort of sustain itself?
So I would say there are two fundamental factors here. In fact, from a global perspective, it's the U.S. rates and rates fall alongside the U.S. dollar. And we do need to see some level of stabilization, which will only happen once the market has a little more clarity with regards to the path of the Fed policy cycle from here. So I think we need to see that before we can see sustainable rally in risk assets. So at this point, what we are going through is more a positioning-driven short squeeze, which is hard to sustain.
Neeraj, I want to ask you about this week's events in the Chinese bond market.
Yeah.
You know, this backing up in yields, and whether you think that might constitute a problem for the banks, and obviously where you think yields go from here on CGBs.
So overall, we are still a little caution on CGBs, and that's more to do with the fact that when you think about the Chinese economy, there's potential for some upside risk from a macroeconomic perspective there as we go into next year. And it's a combination of three broad factors. The first is the zero COVID policy and how that evolves. The second is the broad fiscal impulse and the credit growth in the system, where you have seen certainly a lot of focus in the last few weeks. And the third is the stabilization of the real estate market, where we have seen the 16-point agenda coming in from the regulators to stabilize that market. So you have seen some of that hope coming back and playing through the equity market, pushing the bond yields higher. But I would note that the range of the Chinese government bonds, if you take the 10-year CGB in the last 12 months, has been 21 basis points compared to 100 to 150 basis points for most developed market government bonds. So let's take volatility in the right context here.
It's volatility in China, I guess. Neeraj, yeah, let's talk about the 16-point plan, because I know BlackRock, you've been watching the property space very closely here. Is it really the game changer, as some are calling it, or does it not go far enough in addressing some of the structural issues around the China slowdown story?
So I don't think it's a game changer necessarily, but it certainly is a stabilizer. And if you look at all the details, with obviously more liquidity now ready to flow into the sector, both on stabilizing the consumer demand in terms of probably stabilizing new home sales as well as the starts, as well as giving some lifeline to the higher quality developers, it will bring over the course of next few quarters some stability, specifically in the tier 1 and tier 2 markets with regards to the sector. But does it completely reverse and bring you back to where things were in the sector, both from a fundamental perspective or the asset prices 12, 18 months back? I don't think so.
Neeraj, looking into 2023, long duration, high quality is what you're saying potentially gives the best returns. Is that contingent? Well, that's contingent on what?
Well, that's first of all, as we go back to the fundamental building blocks of rates fall in the dollar for this part of the world, or rates fall for the US assets, I think it will be very important to see stabilization there. But as we get into that stabilization, and maybe it's probably a second quarter to second half story, long duration, high quality assets, emerging markets in general, local markets in emerging market context, there will be actually good performers in the potentially second half of 23.